Financial Journey, the November Wealth Advisory Review, where we talk about how to create, grow, protect, and preserve wealth for you and your family in today's economy. I am looking forward to sharing several new things with you tonight as we move towards spring planning, as we look towards how we're going to make the most of this coming year for you and how we finish out the end of this year well. As always, remember the important disclosures, things like identifying tax issues, planning issues, investment strategies, insurance or risk management issues, making sure that you involve everybody who would help make decisions for you to make good informed decisions as well. And so whatever I show you tonight, it's designed to cover a broad range of people, and I believe it will cover you. But if there's any particular questions, as always, we're available to answer those questions and to work with anybody in your circle of advisors to help you make the best decisions as well. We'll have a time at the end here for questions. If you have those, you can either raise your hand, and for those of you who have mic capabilities, we could actually let you ask your question live and in person. If not, you can certainly chat your question to us, and I'll be happy to go over that and answer that as well. Camera off. All right. Tonight we're going to be covering a market and economic review. As always, we're going to delve a little deeper into getting ready for spring planning, taking a look at your personal economic model, the accumulation and decumulation sequence risk attached to those, and end-of-life issues that have risk attached to them for the planning purpose as well. I'll share with you my final thoughts at the end, answer any questions, and then remind you of what we're doing here in the next 30 days. As we've been talking, I know that we have been for the last 6 quarters looking for, expecting a recession, and we really have not had that. It's not been super great, but it hasn't been terrible either. There's lots of various pieces. Some of those have to do with policies and other issues. Some of those still have to do with the pandemic and how it impacted as a worldwide event, not just the US, but the rest of the world as well. And since our economies are so interlocked, it has had that impact here as well. Having said that, I think there are policy issues that we could do better on. I think debt management, I think handling of fuel costs and inflation, those are issues that have caused the average person to say, I'm a little nervous, I'm a little uncomfortable. And so as we look at the 4 primary engines, these aren't everything, but these represent sort of the big takeaways for the economy. GDP growth is still positive. Business profitability is still mostly positive. I gave it a plus minus, but it's still mostly positive. Unemployment rates are still low. People that want to find work seem to be able to find it. And interest rates are higher, almost 500 basis points, about 5% or more. However, the Fed has decided to stop raising interest rates, at least the last 2 Fed meetings. With that higher interest rate, it means it's costing businesses more, but you would have a hard time telling that by looking at the stock market, although I know there was a bump here in the last 6 or 7 weeks, but it seems to be resolving itself. That's a negative for business profitability, but it's a positive for seniors who are looking to get fixed income off of their money in the bank. And so in that sense, it's kind of a plus minus. These engines of the economy look like they're doing relatively well. Nothing major flamed out yet, so we're going to keep watching, being proactive wherever possible and reactive whenever necessary. And I know that, in fact, I was just watching some material today. I know I could talk about several negative things that we keep our eye on, but in reality, those negative things may or may not happen at the time that we're expecting. It may be something, or some of these items may happen in the next decade, they may happen in the next year. I would just say that if anything like that happens, we'll quickly have another meeting to update that, have another sort of workshop to let you know what's going on so you can stay apprised of what's going on as well. When we look at the markets and the economy, as obviously we can see here from a most recent chart, this is looking at the S&P 500. Yes, it is true. From the high in August, it has gone down. Each high was a little lower than the previous high. Each low was a little bigger, and we did see a sort of consolidation. I know that this most recent upturn in the market changed that, but we saw pretty much a straight line, both like a channel heading down. It did break through the 200-day moving average, which was concerning, but as you can tell, for roughly a week or so, it stayed below and then came right back up and took off again. Volume has been pretty healthy, so it's not as if it's weak volume that's driving it up. It has been a very solid retention of what was happening before and gaining on that as well. And we can see now, as of recently, we are currently above the 50-day moving average. It has tested it, and by testing, if I pull up the most recent chart, you see that it is still held above. That being said, I think this is an indication that we're not ready to see that significant downturn yet. Could that happen? Obviously it could. I'm not telling you that it couldn't happen, but when I look at things like the relative strength indicator up here, it's moving up above the 50 line, so it makes me think that that's probably going to hold a while. We can certainly see the short moving average convergence divergence also moving positive. So I think that we might finish out the year as a pretty decent performance. Again, we're going to be looking at items that are out there that are impacting things like the oil prices, inflation, the high cost of grocery bills for the average everyday person, certainly several wars happening. All of these various issues are impacting a lot of different factors. And so just like you, or maybe more than you, we're watching it very carefully, very closely to make decisions if we need to pull back and adjust portfolios to become more conservative. For many of you, you are more conservative because we have been holding that line since there has been this expectation of a recession. But you've still seen nice performance even within that. So I guess if the confidence came back that the markets were going to take off, we'd probably get more aggressive. So we're holding, we're being careful. Again, proactive wherever possible, reactive whenever necessary. But I can tell you at this point in time, if I were to go back to that plane picture, I see lots of blue sky and a few clouds. And we're watching carefully to see if those clouds are a big problem, a minor problem, or no problem at all. So tonight, I really wanted to spend some more time on spring planning and how that impacts financial planning for you. Personal financial planning, as I've been sharing with you over the last few years, has really become the centerpiece to operate as a fiduciary to help you make the most of your family's wealth. As we've looked at this fiduciary thinking, I realize there's a lot of investment firms that talk in the terms of, oh, we're fiduciaries. But it's hard to be a real fiduciary when you don't understand what a person's life needs are, what their risk management needs are, what their return on life desires are. Just managing a portfolio to match somebody's risk tolerance and their income or liquidity needs, that certainly is fiduciary, no doubt about it. And certainly from a retirement planning viewpoint, if I were looking at like a 401k, that certainly counts as fiduciary as well. But from a personal financial planning viewpoint, it seems to me that the advisor should be very well involved and understanding the client's needs. And so again, I remind you of the 3 phases of your financial journey: the accumulation phase, the decumulation phase, and the transfer phase. The accumulation phase is when you're building resources to get ready to retire or redirect. The decumulation phase, that's once you have retired. It's post-retirement. You planted that flag on the top of the mountain and you started to head back down. And when we head back down that mountain, we have 2 primary areas of concern. One is sequence of return risk or sequence risk, and the other is end of life risk or end of life issues. Because how well we finish and get back down the mountain determines how much is left to transfer to our loved ones, to the people that we want to receive these resources. So with that in mind, I want to spend some more energy tonight talking about these issues a bit to hopefully bring you up to speed. I know I've covered them individually with some of you, but I don't know that I've ever taken time during one of our advisory reviews and said, let's drill down in this, let's break this down a bit more. So tonight, that's what we're going to do. So now, and I know this is a very busy slide. I am so sorry it is so busy, but it actually comes from one of the applications we use, and I thought, I'm going to go ahead and use this to maybe give a picture version of the data I showed last month during our advisory review. just to kind of help understand what we're seeing here is your personal economic model. And on this side, it is what you would have. On this side, it would be if we make changes up here to make a difference. And so you'll notice the investment tanks are different. You can see cash flow. You can also see that one runs out at age 79 and the other one runs out at 94. But for the moment, let's just focus here on what this actually is. And so what this really is this is where your income comes in. Comes in at the top of this tank, and what you're left with is a big tank that is your remaining income potential. Let's just say, for instance, and we're going to use some easy numbers, you make $100,000 a year, you're going to work 10 more years, not including inflation. That means that your remaining economic potential would be about $1 million, 10 years at 100,000. Off of that money that's coming in, you might have some of it that's going to a qualified plan or investments. I know this is kind of small. It says qualified plan contributions as well as additional investments. You might put some money in there, building up for that time when you're going to draw down that tank to live. The rest of that money is going to come through. It's going to go through your lifestyle. It's going to have taxes that are paid out of it. You're going to have some of it maybe pulled off to move over here to savings or additional investment programs. And then the rest you're going to live on with after-tax cash flow. Now, in this model, what we do is, and I showed it last month with a bunch of charts and data and columns and numbers, but some of you said, I'd like to see this in a picture version. So that's what I'm going to show you here tonight to help you understand how this works. And then even more importantly, to move this discussion to sequence of risk or sequence of return risk as well as end of life risk issues. So let me pop out of here for a second and move over here to circle of wealth. Oh, look, there's me. All right. So let's take a look here, retirement ready or not. Skip past those numbers. What we did was, I'll put this in here, 189,000. All right, 6%, 5% defined benefits. Oh, goodness gracious. It took it out of there. Let me put this in quickly. Social Security income. We're going to do this at 40,000 off of $100,000. We'll put in a 2% cost of living adjustment, start at 65, go to age 90. All right, and we'd make 50% of that taxable because depending on what your income level is, you might have taxation on that as well. We're going to change lifestyle. Let's see here, so 612. Oh, got to put taxes in at 16%. I'm sorry, 15%. Anybody can do this job, just telling you right now. All right, so we got that in there. There we go. Okay, so if we take a look at this and we say, well, what does this look like from the personal economic model? What we'd see is, we'd see a person starting here retiring. We turn on this income, and what you'll notice here is that their income potential is going down with each surpassing year. And then this goes down over here. We see their investments building up. So then we get closer to age 65. Actually, we go back 1 year. You can see that we build up investments. You can see that we would actually have some money in savings that'd be available to us. Maybe our investments could be up in here. And this is safe money, and this is risk money. So maybe you're a 50-50 person. Maybe you say, I can handle some risk, but I got to have some safety as well. So we put that right in the middle. That means that that person would then have better income potential, or I'm sorry, better growth potential, but they might have some income potential as well based on the safe portions of the money. But then as we continue on with that, what we see is, we see that we'll turn the step back on again, and we see this begins to go back down as they draw from life. And that's what I was showing last time, is that in our calculations, and I think what I showed you was a chart that looked like this, where it showed how things worked, and it came across the top here and said, well, if you make these adjustments, you could see that portfolio continue to get you from where you are to where you want to be. In this particular case, the client runs out of money at age 72. If we were to be able to, for instance, save more or earn more on our money or work longer or spend less in retirement, those factors in a combination can help to make it so you can have more capital to meet your long-term needs. And that's really what we were going to, that's what we talked about last month, and that's what I wanted to take some time to illustrate here tonight, that with some minor changes, and let me go back to our presentation again. There we go. With what we had done here is I identified the changes we made to make it so that instead of running out of money at age 79, I recalculated and said, well, what if instead of getting, you may remember on the previous one, it said 6 and 5%, what if we could increase our rate of return to 7% so that we get a little more money now and a little more money in retirement? What if we left our savings as it was, saying we'll put away, 2 IRA contributions a year, plus a little extra money, so about $12.50 a month. What if we work a little longer? Instead of retiring at 65, but we increase it to 68, and we maintain the same lifestyle that we had originally desired? So I only changed 2 factors here: retire 3 years later and invest a little more aggressively than you have before. Now, when I say a little more, 1%, as you can tell, means a lot. In this case here, we went from having a investment portfolio of about 1.2 million to an investment portfolio of about 1.5 million. And that 1.5 plus Social Security was able to make the difference to make it so we had enough cash flow to last to age 94. Now, you might say, well, 94 is not long enough, Frank. I want to live to age 100. We just continue to adjust the numbers. We can't adjust inflation. We don't really have control over that. But we can say, well, I'm willing to work a little longer, or I'm willing to save a little more, or I'm willing to invest a little more aggressively. I'll reduce my lifestyle. These various pieces make it so that you can create the model that makes it so you can have confidence that you will have adequate resources to last as long as you do. Now, I would also say to you that this is nothing more than a very, very complex calculator. And it's trying to pull in various pieces like Social Security and taxes, income, investments, outgo for lifestyle expenses, and so on. It's trying to marry these various pieces together to create a model of income and outgo, what you own and what you owe, and how that all fits together in a longer term process, including the rising cost of living. Now, as we put together numbers, and obviously this is looking out from age 68 to age 90, we're talking about 22 years there. That's a long time. I will tell you that when I'm doing planning, we definitely focus on what I would call direction determines destination, and that's why we run the numbers out so far. But realistically, I'm looking for the next 5 to 7 years to see if, are we on track? Is it going to work? Does it look good? Does it make sense what we're doing? And as with anything, garbage in, garbage out. So it's very important that when we're doing our spring planning with clients, that we're looking at the numbers realistically and as they are in your situation. I worked with many clients, 1,000 or more clients in my 3.5 decades of doing this. I can tell you, no one has ever had the same situation. So each model is unique, each plan is unique, and the outcome of each is also unique. So that's why we work so hard, so diligently during spring planning to make sure we have good numbers for you, so that we can make sure that your personal economic model makes sense, that when we look at your unique personalized possibilities, that they make sense as an outcome goes. When we look at your net present value and your net potential value, that they make sense both today, in a few years, and longer term with that. So when we're looking at this here, this is a way to capture what you may be experiencing, to identify the strengths and the weaknesses in your situation, as well as the opportunities and the threats in your situation, which that last piece there, threats, is what brings me to the next part of our discussion, which are a couple of risks that we see. If you remember, on that side of the mountain, phase 1 is where we're accumulating wealth. Phase 2 is where we're decumulating, or post-retirement, we're taking distributions. And there are 2 risks there that, in my mind, are very serious. And I want to make sure that we help clients to think through those possibilities. And so sequence risk means that where the performance numbers fall in line, meaning that you have some good years and some bad years and some fantastic years and some terrible years, that the way those numbers work have a big impact on what happens to your planning as you accumulate money, and then when you retire, as you start taking distributions. These two components are called accumulation sequence risk and decumulation sequence risk. Now, I've said this many times on this review, the advisor reviews I talk to you with, where I've made the comment that the accumulation years are very different than the decumulation years. The pre-retirement years, when you're still working, have a significantly different model for investment strategies than the post-retirement or decumulation years. And I comment often that a lot of advisors only understand the accumulation side. They only understand how the sequence risk works on the accumulation side, but the decumulation, not so much. And I know it's a bold statement, but I would tell you, I think as many as 80, maybe more % of advisors only understand sequence risk on the accumulation side, but not the decumulation side. So I'm going to attempt tonight to share with you how those two work to help you understand why, from my viewpoint as a wealth manager, as a personal financial planner, how we're trying to help clients offset that. And the first step is to understand it. So here's what I would say. Sequence risk is irrelevant during your pre-retirement phase, and sequence risk is critical during your post-retirement phase. And that's a bold sentence, but I'm going to prove that because I want you to understand why that is such a different issue and why it's so important as you plan for your future. So we're going to go back here, pull up our sequence risk charts here. So what we've done here is pulled up investments. I'm going to change this to 90. I had to turn off my computer, and apparently it changed some things. So I'm going to, I'd make an adjustment here. So let's see, 1973. I think that's good. I can, yeah, this will work. Okay. So I'm making assumptions. The person has $1 million portfolio. They're 65. They're going to retire. We're going to say their life expectancy is to 90. So we're looking at 25 years out, doing a 5% withdrawal, meaning that they're going to pull out about $50,000 a year. And we're going to say inflation's 3%. So we have to bump that $50,000 up by inflation. And then we're going to take a look at what that portfolio looks like after this is getting up the mountain, and then this is getting back down the mountain. So let's take a look at the first issue here, which is the accumulation years. Now, what I'm going to do, I picked out from, and these are actual S&P 500 performance numbers, and I picked out a period of time, 25 years, from 1973 till now. And you may remember, if you were around in the 70s and we're doing some work investing, that we had some bad times back there over here. So this is the historic numbers. This is where I shuffle it. When I say shuffle it, what I mean is I'm going to move it forward, in this case, 1 year. And what it means is, you notice it took the, where we're at here, let's go backwards. I think it'll be easier to see if I do backwards. Let's get it back here so they match exactly. There we go. Okay, so now they're exactly matched. So if I move this forward 1 year plus 1, it moves things. So here's the 17 is moved forward. Here it was here. So if I move it again, now it's down here. We've added the year in. Now, what you might think is, and let me just move it this way. I want you to notice something. We get to $1 million where we're starting with our calculation back at age 39 and putting the money in and seeing the performance, and we end up with $1 million at age 65 in this calculation. But I want you to notice something. Even though I'm shuffling the rates here, I want you to notice it stays $1 million the whole time. Even though the rates are changing, you'll notice the year before changes. But you'll notice it stays the same the whole time. It ends up at $1 million because we're not pulling money out. I've commented many times that when you are in that pre-retirement phase. You've got a job, you're making money, you're contributing to your plans, you're living life. The market falls 5%, 10%, 20%. It's annoying, it's frustrating, it's uncomfortable, but because you have a paycheck coming in, as long as you don't lose your job, it's not terrifying. It's not the end of the world. And even from sequence risk, how the returns can be adjusted, you'll notice it stays the same the whole time. It doesn't change. And with that in mind, that simply means that no matter how good or bad the markets are, as long as you keep doing what you're supposed to do, pre-retirement, sequence risk is a non-issue. Let me get these so they're exactly matched up. So what I want to do is show you the graph so you can see the graph. Let's see. Oh, there we go. That was it. Okay. So now if I put this as a graph, the green is both well, you're going to see it in a second. So let me adjust it. So the yellow is what the historic returns were, what you just saw a moment ago, and the green is how I shuffled it. So I'm shuffling it. You'll notice that even though it does better or worse, what happens is it still ends up at the same place every time. Now, all that's happening here is we're just simply changing the years. There's a much more complex version of this called Monte Carlo analysis, where what it does is it shuffles it, it moves them around. It doesn't just simply move them 1 year forward or back. It actually switching them around different times, different periods of time, taking a look at a best case, a worst case, most likely scenario. But this is a very simplified version of that. So you can see that even though, for instance, and this would be a good example. So somebody, they've been putting away their money for retirement. They're at $869,000 at 56 years of age. And they're like, yeah, I'm on track. Everything's gonna be great. And then the market goes down and it goes down, comes back up, it goes down, goes down. What happens is they get very annoyed and frustrated because they're like, I could have had more money in retirement. And that's part of the reason I'm showing you the shuffle, because it doesn't really change anything. Now, you might say, well, goodness, Frank, does it matter at all if I invest? Well, no, this is using the S&P 500. And as I've said many, many times before, how you balance your portfolio, if you put it more aggressive, for instance, using the S&P 500, if you're only invested 50% in the S&P 500 and everything else is in CDs, all right, you've got a 50-50 mix of aggressive and conservative, that's going to come out with a certain model. But the S&P 500 piece is going to be the same beginning and end, because you're going to have the same time frames and you're not taking out any withdrawals. And that's really the key right there to that piece. So now let's switch it to the distribution years or decumulation phase. We've taken and used exactly the same numbers here, using exactly the same S&P 500 numbers. You'll notice it starts at -17, -29 the next year, and so on. If I run it down, you'll see that basically what happens here is, in both cases, we run out of money at age 81, if that example happens. But what happens if we switch the years around a bit? So now let's do some shuffling and see what happens here. We'll go to the very end, see if we can make this money last longer. Oh, okay. So switching it out 1 year, just 1 year. Again, 17 here, -17 here. We start with a 26% in the first year. Again, this is actual performance. That one period of time made it so the client's money lasted until age 90, versus over here it ran out at age 81. Remember, at the top of the mountain, I have S of R risk, sequence of return risk. One bad year or a couple of bad years in the market can really destroy a person's retirement plan. That's why sequence risk isn't quite as important, other than it's just annoying and frustrating in the accumulation years, but in the decumulation or distribution years, it's terrifying. That's why having a plan in place is so critical, to make sure that we're on top of what we're facing. Let's shuffle a few more times. So, okay, now I just shuffled 2 years. And in that 2-year shuffle, we went from, I think it was 40,000 a moment ago, we're now at 1.8 million. And again, it's because we started out with 2 really good first years as compared to 2 really bad first years. with that in mind, it's a totally different ball game when we're trying to offset sequence risk. And as you can tell, if we can offset bad years by having a plan not to pull in, and part of the issue here is it's pulling this 50,000 out in this calculation. I guess over here it's pulling it out when the account's down to 784,000, from 1 million to 784, and then when it's down to 515, it's still pulling out 50,000. That's 10%, almost a 10% withdrawal. But over here, it's pulling out 50,000 from 1.2 and then 1.5 million, because it's pulling out in both time frames. And so having a good plan in place to make sure that we pull money out during the right times, and that we have safe money or money that's very stable to offset and produce that income, is critical to our decumulation or distribution phase coming back down the mountain, phase 2. So now I'm going to show you with the graph again, same kind of thing. So you can see here in the historic sequence, the client ran out of money. In the shuffled sequence, they actually ended up in a better place. Now, you and I don't have any controls over what years the market's going to be good or bad. That's just what it is. If we retired in 2008, then we were sort of stuck with that problem. However, having a good plan in place might have meant we said, well, let's work a couple more years so we don't have to pull out in those bad years. Again, most of you wouldn't take a vacation or a long trip or move to someplace if you knew it was going to hurt you, your family, and your finances. So having a plan in place is like having a blueprint or a roadmap to tell you what you should and shouldn't do. But without that plan in place, I'm going to retire in 2008. I know the market's down, but I'll be okay because I have $1 million and I'm only pulling 50,000 out a year. That's fine. But having a plan in place helps us to decide more carefully what we need to do, so we can make informed decisions. And with that in mind, we can then have a much better opportunity to make our resources work well through the accumulation phase, through the decumulation phase, and then have resources left to transfer, if that's what our plan is, to loved ones. So if we keep shuffling this a bit, you'll see that in changes at different times, again, starting out in 1973, if I pick 1990, for instance, it has a different outcome. As a matter of fact, let me just do that. Let me change it so we can pick 1990 so you can see that instead. Let's do this here. All right. So now we still end up with $1 million during our accumulation years. Nothing's changed there. On the distribution phase, pulling out $50,000. Our money lasts us the whole time, so that was a good time frame. But let's now switch it here. Let's shift out some of the years and see if we have a better or worse outcome. Notice right down here, this is what we're looking at the whole time, and you can see the difference here. So this was 1.3 million at age, almost 1.4 million at age 90, and this was 2.1 million at age 90. So about a $756,000 gain. You'll notice here, worst initial year, and software does this, identifies that if you started in 2000, your money runs out at age 77. But if you started in 2009, the best time to retire would have been age 91. Of course, who knows, whether we're retiring in the best year or not. That's why having the plan in place for the accumulation phase, pre-retirement, and then having a plan in place in the post-retirement phase are critical to this, because it is the difference between making it work and making it not work, making it not last as long. Again, the yellow is actual, the green is the historical or shuffled sequence. So we can see here that now in this example, we ran out sooner. So our historical was better. This example ran out in 84, at age 84. Now, my purpose to this is not anything more than to say, when I say to you as a client, as your advisor, as a friend, we really want to make sure that we have enough resources to last as long as you do. And I say that in that accumulation phase, sequence risk isn't really that big of a deal. That's why most advisors don't really stop to think about it. But in the distribution years, it's critical. And here's why. In this period of time right here where the market went down, during that year, instead of pulling out that 50,000 from an account that went from 866 to 496, 500, it went from 800 to 500. Instead of pulling out that 50,000 then, we want to have money set aside to pull from a bucket that's stable so we don't have to pull out when it's down like that. That's how we can offset this to create a better outcome. And for those of you who are in that distribution phase, and we've shown you how to set up your tactical income account and your growth strategy account, this makes more sense. Those of you who've not done this yet, it probably doesn't make quite as much sense, but I promise you, when we get into next year after spring planning, I'm going to be showing more of why we do it the way we do it to back up this discussion. But in prepping for spring planning, I really wanted you to have some time to be able to recognize why we're doing what we do. This is what I would call fiduciary, not just investing to your risk tolerance or your cash reserve needs or your income needs, but even more so to invest towards your life needs, to generate income in a tactical way, and to have strategic growth in a model that helps to offset what you're seeing here on this screen. So hopefully this is giving some insight to that. Let me go back to the advisory review. So as I was saying a moment ago, and hopefully it's a little more obvious, if not, next time you're in the office, I can do this. You just say, show me that sequence of risk thing, and I'll be happy to go through that with you. But during this side of the mountain, it's not as big a deal. We don't like it. It's annoying and frustrating, but it's not as big a deal. But when you start pulling money out of the account, it's a much bigger deal. It's a significantly critical action to make sure that we minimize any of that sequence of risk return, or sequence of return risk. As you can tell from here, and the differences on the two charts I showed you is during the accumulation years, no matter how I shuffled it, it always ended up in the same place. But on the distribution years, this wealth gap right here was changed by the distribution or the shuffling of historic returns, primarily because of this right up here. And during the time frame I showed you for the 90s, the average market performance was 8.53%. And that's really important to understand. If you're pulling out 5%, you think, well, if we're making 8.5 and we're pulling out 5, that should be more than enough, right? Well, you have to remember, we've got inflation added to that. Cost of living going up, and then going up the next year, and then going up the next year. Even though we're making 8.5%, that still may not be enough to make this work. When I say we are, the time frame I showed from the 90s until, what would that be, 2015, that time frame was enough to make it so the money ran out sooner. Market losses during your distribution years can destroy your retirement nest egg, and that's why we try very, very hard to make sure that we are on top of that with you and for you. Now, we had the sequence of risk up here, but now I want to talk about end of life issues, because end of life risk, those are actually things that it's sort of hard to really imagine unless maybe you've had a parent who's gone through it. And if you've helped a parent go through it, you might understand a little more about what I'm talking about. But some of those risks come out to things like increased healthcare costs. You know, when you retire at 50 or 60 or 65 or even 70, your health is usually still good enough that you can do some traveling, you can go enjoy life a bit, you can do some things. Yeah, it's maybe not be as good as it was, 10 or 20 or 30 years earlier, but it's good enough you can still have that quality of life that you hoped for and were looking for in retirement. But as you move into your 80s and 90s, that all begins to change. Later 80s, you start looking at much more health expense, and that greater health expense begins to eat away at the finances. So whereas you were spending money on travel and events and doing things, a decade or more before, now you're spending that money on healthcare. And the reality is, historically or statistically speaking, most people spend more in the last year of their life on healthcare expenses than they did in all the other years combined. So understanding that and planning for it is another key component to this. Incapacitation challenges. You become incapacitated. You from a long-term care viewpoint, your assisted daily living needs, toiletry, feeding yourself, dressing yourself, bathing yourself, being able to get up. All of those things are incapacitation challenges that people, as they get older, begin to have to deal with. That can create some problems. Incompetency concerns, meaning that we have dementia or Alzheimer's or something that's impacting our ability to think, those can create problems. Situations where we've had clients who they were having incompetency issues, dementia, Alzheimer's, but nobody around them really had identified it yet, or in some cases, they weren't even willing to talk about it yet. And the decisions those people made during that time when nobody would talk about it, in some cases, were very costly. And so being willing to honestly talk about when you are having a hard time making decisions or thinking, whether it's incapacitation or incompetency, it is something that the longer we live, the more likely we are to face some of that. That's another end of life risk that can really challenge your finances and your family's future when you've passed. Long-term care needs. Now, this is not a discussion to get you to buy long-term care, but I really want you to think for a moment about what long-term care needs really mean. Forget about insurance to cover it or whatever. What you need to understand is a couple of things. One is Medicare does not pay for long-term care. Medicare will pay for the first 100 days of a skilled nursing home stay, which is roughly less than 2% of all nursing home stays. 98% are not skilled. And so with the non-skilled nursing care, 98% are covered by other dollars. As a matter of fact, if I look at this here, what I would say to you is this is from a company called Genworth. They do an almost annual. This one's from 2021. They haven't updated it yet. I think they will this year. But we can pick out various states. We can pick out even cities and find out what the average cost is for long-term care. But what they're identifying is you say, well, I want to stay in my home, Frank. I am not moving out of my home. That's fine. You can do that. If you just need homemaker services, that's all you need. That's great. That's about a little less than $5,000 a month. And that's somebody who comes in and helps with food, helps with laundry, helps with cleaning, things of that nature. On the other hand, if you need a home health aide, somebody to help with medical issues, somebody who's skilled medically in certain aspects, that's going to cost a little over $5,000 a month to have. And if you want to stay in your home and you need both, you add those two figures together. So you're looking at a little over 10 grand a month to stay in home. And that's in terms of 2021. I'm going to show you that if we expand it out to 10 years, what that looks like. But now I'm not saying that's a bad thing. I mean, if you can stay in your home, you have the financial capacity to do it, that's fantastic. But if you don't have the financial capacity to do that, then having a plan for that end of life issue is also critical. Again, I point out that you're either going to pay for it with your money, or you could pay for it with Medicaid money, or you could pay for it with long-term care insurance. Now, Medicaid money is a little different. Medicaid money requires you to have a health need that supports it. Medicaid won't pay unless you have that health need. And then two, they require you to be broke. And there are people who can help you to adjust assets so you can qualify for Medicaid, but that usually requires some intense planning and training ahead of time before you try to apply to Medicaid. When I say usually, it always does. So you got to have those ducks in a row before you start on that. And then if you have long-term care insurance, you got to meet the requirements they have, which usually, it might be in all cases now, means that of the 6 assisted daily living needs, or ADLs, you have to be incapable of doing 2 of them, and then the insurance company will pay. Otherwise, it's your money, Medicaid program for your state, or long-term care insurance. That's the only way it gets paid. Medicare does not do it, and they don't do it for free. So it can be a big expense, and if the average person has about a 2-year stay at $10,000 a month for home care as a 2-year need, you're looking at $240,000 of assets that have to come out of your retirement nest egg. And then if you pass, your spouse now has $250,000 less money to meet their needs. And so having a plan for that is critical as well. Now, there are some other things you can look at here. Adult daycare, adult day health care, about $1,600, almost $1,700 a month. Assisted living facility, kind of a retirement center, about $4,500 a month. And this is where you don't have the Medicaid, or not Medicaid, but the home health aid and the homemaker services needs. You're still kind of able to do it on your own, but you're living inside of a retirement center. And then if you have nursing home, $7,900. This is national. $7,900 a month for a semi-private room, or $9,000 a month for a private room. And again, this is not covered by Medicare. If you have a skilled need, first of all, you can't stay home if you have a skilled need. They're going to want you in a facility like this, and they'll cover the first 100 days of that. Now, after that, it's up to you or Medicaid or your long-term care insurance. If I go to the next slide, what I did was, I said, well, let's use a 4% inflation factor, and let's take that out 10 years. So in 10 years, by 2031 from this study, what was a little under 5,000 is now 7,300. What was a little over 5,000 is now 7,600. What was $1,690 now 2,500. What was 4,500 is now 6,600. A semi-private room be about 11,700, and a private room about 13,300. So again, having a plan for how you're going to handle increased medical expenses, how you're going to handle incapacitation issues, incompetency issues, and God forbid, but if you need a long-term care solution, how you're going to handle that. That's what I'm referring to when I say end-of-life risks. Went the other way. End-of-life risks, making sure that what you have worked so hard all your lives to build up in the accumulation phase, to manage well on the decumulation phase, then at the end, make sure that, you know, if you have a spouse, your spouse is taken care of if something happens to you, and then whatever you would like to see transferred to your loved ones can be transferred. If you don't have any need to transfer anything to them, that's great. You don't have to do that, and we just build the plan differently. But in the end result, what we're looking for is a way to help make the most for clients from the pre-retirement, post-retirement, and transfer or death phase. And considering the risk that we have at the beginning of retirement, at the end of retirement, that's what I'm referring to with sequence of return risk and end-of-life risk issues. Again, and I know this is a little heavier tonight, and sorry about that, but we're still trying to figure out what's your desired return on life. When you take your last few breaths of air on this planet, we want to identify what you need, protect what you have, make sure that you can accomplish the goals that you want to accomplish, and have that return on life that you're looking for. That's what planning is about. It's not about making your life worse, it's about making your life better, to make the most of what you have and protect, create, grow, protect, and preserve. That's why when I use this little triangle chart here, what I'm really trying to say at every single time is that we see having a return on life financial plan, having a personalized investment portfolio, a personalized risk management solution. I believe that sort of a dynamic financial planning approach, that's what seems like fiduciary wealth advisory to me. Not just making sure we're investing according to risk tolerance, but making sure that we're thinking through everything as if we were sitting in your house, on your couch, having to deal with the things that you're faced with, even those things that keep you up at night. And so having a plan for that, a well-defined direction with an intentional approach for measuring how well your journey is going and helping you to stay on track to achieve that destination. That's what I think of as fiduciary wealth advisory. As I've shared with you before, your life's journey, your life's financial journey, which is what we're here to help with. We help you identify your destination. We help you identify your dates and times. We help you put together your plan. We help you identify the supplies and resources that you have available. We help you look at the tools and equipment necessary to make sure you're on track and stay on track. And if you get off track, how to get back on track. And we're that advisor or mentor or coach you're the hero of the story. We're just the support systems. We're the guide to help you make sure you're on track to where you want to go. And that's what this is all about. This is what gets me up every day, and it's what we're trying to do every time we talk with you. Not only are we looking at the facts and the figures, but also the desires and the feelings. And so your retirement mentality, finding your return on life balance, what your current life portfolio is for those 168 hours a week you have, and then identify what would you like it to look like? How much time would you like to spend with family and friends, or work and career, or downtime, or sleep, health and fitness, personal growth? What is it that you want to accomplish? And when you're doing those things, envisioning that return on life, what are the areas you want to focus on? This isn't about, building up numbers and creating growing wealth and then just sitting on your couch. It's about doing these things. It's about accomplishing the things that you feel called to accomplish to help you enjoy your journey. And sometimes it takes for people they've been doing the work thing for so many years, they haven't really stopped to consider the possibilities. That's what we're trying to do, is to help you envision your return on life. If you already got it figured out, fantastic. We're going to help you work with that. But if you haven't, these are other resources that we have available through your return on life portal, as well as your financial life plan portal. Because my hope is, and see this chart here, I've shown you this before, but I took some time this last month to put some of the information down, because those little icons and emblems didn't really say anything. It's my goal that when we look back 10, 20, 30 years from now, we can look back and see that when you were 58, you did this thing, and when you were 59, this thing happened, and when you were 61, this thing and this thing happened. And my goal is to help our clients be able to accomplish their bucket list, as well as be on track to achieve the life transitions they are looking to accomplish along the way, those things that they have to deal with versus the things they look forward and want to deal with. So our goal when we do our spring planning is to be able to look backwards and say, well, 2 years ago we got this done, and 3 years ago we got this done. And that's the plan, to help you review your journey to make sure it's matching what you want it to look like. We use these 4 apps as well as a bunch of others, but these 4 are available to every client. Your financial dashboard, which takes a look at all of your accounts together, both with us and outside of us, your income and outgo, what you own and what you owe, and then help to create that foundation to calculate out where we're headed. Your portfolio dashboard, that's the asset you have with us, so we can see, you can see how we're doing, how's the performance working, is it matching what your goals are, and if we're on track or off track for where you need to be. Your risk reward evaluation, to make sure that we're building portfolios both with what we manage and the outside of us. I mean, I just sat down with some clients and reviewed their 401k money. We're not managing that. That's assets held away. We help them rebalance that portfolio to match their risk tolerance. And then the last thing we're looking at there, your financial life plan, understanding your bucket list and your transitions list to make sure that you're on track to match up your feelings and desires to the facts and figures of your situation, to make it so your personal and financial needs are matched up perfectly. Those tools you just saw, they give you a 24/7, 365 dashboard that ties all your finances together. Along with that, you get a report suite available for huge, like there must be 30 different reports in that suite that you can get to. An electronic vault to store everything, so that God forbid if something happened to your house, you couldn't get your box out, you can go to any computer that you have access to with your passwords and IDs, and you could access it and print it all out, so you got all your critical information back to you again. Planning and wealth management reviews for our planning clients every 4 months. Spring planning for the first 4 months of the year, investment and risk management review the second 4 months of the year, and tax and estate review for the last 4 months of the year. Looking at your beneficiary, estate design, income taxes, annual risk management assessment for your insurance programs, your return on life review, an update of your transitional and life goals, and then a monthly advisory review like this one right here, helping you update what's going on with wealth management strategies as well as economic and market issues. That's what we're trying to do to create that dynamic fiduciary wealth advisory model. So tonight, what I've gone through here, let me see the time. Oh goodness, I'm doing good. So we did a continuing, and my encouragement to you is just like we're doing here, continue to monitor economic and market conditions due to recessionary concerns. Knowledgeable financial planning can empower your financial future. I'm sure that when you tuned in tonight, you weren't thinking to yourself, man, I hope he explains sequence of risk returns and end of life issue risk. I'm pretty sure you weren't thinking about that, but my goal is to educate you so that you can understand the points that might not be obvious to you. You're busy living your life, taking care of work, grandkids, children, doing what's important, church, all the things that matter. Our goal is to give you the knowledge so you can make great decisions. And so knowledgeable financial planning can empower your financial future. Understanding your personal economic model, it's critical for creating, growing, protecting, and preserving your family's wealth. Accounting for that sequence of risk and end-of-life issues risk is crucial for a successful outcome in that second phase of your financial journey. Return on life or ROL goals add your desires and feelings to the facts and figures that contribute to your family's enjoyment of your financial future, which who cares if we just make money? Let's make money and have a good time in the process. That's what we want for you. And fiduciary wealth advisory requires a dynamic financial planning strategy to help you and your family manage wealth wisely in today's complex economic environment. All right, this is that place where I'm going to let you know we can do questions. You can raise your hand, I'll be able to see that, or you can type your question in the chat box, I'll be able to see that, and we can answer those. So again, I will set that aside right now. If you have questions, I'll come back to that in a second. Our next advisory review is going to be December 12th at 5:30 in the afternoon. It's a Tuesday. And again, we're going to continue to build on that. Probably going to spend some time on a few other issues just prior to starting our spring planning with all of our clients. So again, tune in. We're going to talk about strategies for creating, growing, protecting, and preserving wealth and income for your family. If everything's kind of the same way, I'll give you an update on the markets and the economy. If it's different, I will tell you that as well. And if something dramatic or catastrophic happens between now and then, we won't wait till December 12th. We'll get back together and talk sooner. Take a look at solutions and strategies for you, your family, and if you're an entrepreneur, your business, and take time to answer your questions as well. And as always, if you have a friend or family member who you think could benefit from this, please let them know. We'd love to have them be part of this discussion. So I've gone over the market and the economy. Hopefully got you a little more thinking about how to get ready for spring planning. Hopefully the personal economic model, whether it was the data last month or it was the little tanks and everything this month, understanding, maybe have a little understanding now about accumulation, decumulation, sequence risk and what that means. I don't mean to be a downer, a Donnie Downer, but end of life issues risk, wanted to make sure you understood why I think that's an important thing. Gave you my final thoughts. I haven't answered questions yet, but I will, and then remind you of the next review. If you have friends that you want to invite, just reach out to Kayla. She'll make sure they get an invitation. And if there's anything that you want to talk about in the next event, also email Kayla and say, hey, would Frank talk about this? This is something I'd like to talk about. Oftentimes you come into the office or we get on a webinar and you ask me questions, I answer them. Sometimes I'm like, that's a good question. I'm going to make that part of our next review. But don't wait till then. Just say, hey, could Frank maybe cover this next time? And I'd be happy to do that. All right. I am not seeing any questions or raised hands. And as I say every single time, when we don't have questions, it's either because you are so confused you don't know what to ask. I'm hoping that's not what it is. Hopefully, I actually gave you some information that caused you to say, you know what, I understand just a little bit better about what we're trying to do here. So that is my hope. All right, well, it is that time of the evening, 6:30. My goodness, I don't know if I've ever hit the button like that. So I am going to get ready to go have some dinner. I think I'm having enchiladas tonight. I don't have to check with Jane and find out what's going on with that, but I think that's what's happening. Having said that, though, I hope you have a wonderful weekend, wonderful week, wonderful weekend. And then, hey, next week is Thanksgiving. So blessings for Thanksgiving to you and your family and friends. I hope you have a wonderful holiday. Thanksgiving is actually one of my favorite holidays because it's the time when we are thankful. Sometimes Christmas doesn't seem that thankful, but I can tell you, Thanksgiving always reminds me of being thankful. And while I was saying that, somebody decided to ask a question. So let me see what that is. Oh, thank you, Diane. I agree. Happy Thanksgiving to everybody. And come back. Yep. Happy Thanksgiving to everybody. Enjoy time with family and friends, and say a prayer for all of us and what we're doing for you, and we're praying for you too. Have a wonderful night, a wonderful week, and a great Thanksgiving. And I'm heading out now, so I've rambled enough. God bless. I'll talk to y'all soon. Bye-bye.